I'm here with Gary Reynolds, Chief Investment Officer at Courtiers, to find out his views on the year so far and also dig into a research paper I caught wind of that he'd written recently. Gary, you've issued a paper to the investment team, which to me then says it's of some importance to our investors. I wondered if you could talk us through it.
Well, the question we've been asking ourselves on investment team is, will interest rates drop back down to the levels they got to in the summer of 2020? And the paper was designed to look at where interest rates may go in the future, and is it possible they'll drop back to sub 0.5%, at least on base rate, and long-term rates at below 1%, i.e. government bonds. And the conclusion we came to is that that's very unlikely to happen. Do you want me to expand on those reasons, Leo?
Yes, please, Gary. I mean, we've got hold of the paper as well, and we've published it. It is authorised for public release. So we've included it on the website for viewers to click onto and look at here. But I'm mindful some investors may know more than others. So yeah, if you could go through those reasons, I think that would help a lot of people understand.
Sure. So I think what's interesting is we've been through 2 or 3 decades of gradually falling interest rates. Now, don't think base rates, think long-term bond rates, the type of rates that businesses borrow over the long term, the rates that really affect what you pay for your mortgage. And if you go back to the late 80s when rates were relatively high, they've been dropping for really 30 years. So as rates drop, bond prices go up. And because the bonds that are paying a rate that's higher than a falling rate, the price goes up to bring that rate down to the current market rate. And for those of us that lived through the 70s and 80s, it seemed a real anomaly. What then made matters worse was that what drove rates down further was the quantitative easing introduced by first Mervyn King in the spring of 2009 to counter the negative effects of the global financial crisis, and then a repeat of that in the spring of 2020 when Andrew Bailey at the Bank of England, then obviously the governor that had replaced Carney, who had replaced King, decided to engage in another batch of quantitative easing. So all in all, the conclusion we came to was this: that interest rates hit record lows in summer of 2020. And when I say record lows, they were record lows for the UK, where we can track the rates back to the early 1700s. And they were record lows for global interest rates, which can be tracked back 700 years. So the UK and global interest rates hit all-time lows in the summer of 2020. Now, anybody watching this that believes in mean reversion will have expected that rates would bounce off that low. And that was our call, which is why we went into 2022 with hardly any long-term bonds in any of the portfolios. And that meant that we escaped the 40% decline in long-term gilt prices during the last year. The question for us was, do we start building up those gilt portfolios again now? Is there a prospect that rates will again drop back, so we would want to be holding lots of bonds to benefit for a price uptick? And the conclusion we came to was, we don't think there's any chance that rates will go back to the lows they hit in the summer of 2020, for 2 main reasons. One, investors have had their fingers burnt. Losing 40% makes you very of what's meant to be a safe investment, makes you very wary of buying long-dated bonds again. And 2, the Bank of England fired in 440 billion of quantitative easing between 2009 and 2020, when the economy was sort of flat on its back. And then it did the same again in a just under 2-year period from March 2020 to counter the effects of the pandemic. Problem with that was, in terms of the pandemic, the economy was shut down. So while the Bank of England flooded the market with liquidity and put more money in people's pockets, they couldn't spend it, at least not until the economy unlocked. And then what did we get? we got a repeat of inflation, which went above 10%. So, Leo, very unlikely, if you're hanging on to get a rate offer of what you got in the summer of 2020, you may be waiting another 700 years for that to happen.
Thanks, Gary, for that extra insight. And we do invite any questions around Gary's research paper. Gary, just looking more broadly now to 2023 so far, we're well into February. How's the year panning out to you and the investment team at the moment?
Well, it's okay. It's been better than sort of the start to last year. I think James made the point in his recent summary that there are some good bargains out there. We're finding stocks that are very expensive and stocks that are very cheap. And anybody that's got used to our investment philosophy over the past 20 years is don't overpay. Do not overpay. That's a mantra that we use all the time. So we're looking for businesses that are not expensive. So you're not paying high multiples of the business's profits to buy it. And we avoid the ones that are pricey. But just because the business is cheap doesn't mean it's good value, and we want to make sure we've got businesses that are sustainable, can be defensive, have got a future, but we're not overpaying for future returns. And the point being, Leo, there's lots of them about at the moment.
Are you comfortable with the performance of the Courtiers funds to date this year, and specifically the recently launched Courtiers Ethical Value Equity Fund?
Yeah, Eve, the Ethical Value Equity Fund, has got off to a pretty good start. We're very pleased with that. We've been working on getting the number of stocks up to 40, and we're just about to get there now. So I think it's got some good companies. And the idea is that people that want to invest with ethical screenings and in a sustainable way can do so without compromising their long-term returns. And I think it's so far so good, Leo. But you're in Eve for a marathon, and we've covered about 50 meters so far. But the first 50 meters have been okay.
Thanks, Gary. Now, I'd just like to jump across to some recent commentary that we launched regarding succession planning at Courtiers. We've heard everything from our Chief Executive Officer, Jamie Shepherd. What do you have to say?
Well, Jamie and I are not getting any younger. And the company, the size it is, and it's been very successful, you've got to have a proper succession plan. But I think what Jamie's done is made it very clear. He and I love what we do. We love working together. I don't know how he's put up with me for well over 30 years now, but he has. It's been a great journey, and we're very excited about the next 20, 30 years. But the next 20, 30 years will be different to the last 20, 30, and you want youngsters pushing and taking it on. So we've decided that Courtiers will continue. We've both decided we love working in it. And I thought Jamie made it very, very clear. And obviously, Leo, we've put that out there because clients legitimately ask the question, is there going to be any major change of ownership? I don't want to slag off any of the big banks or other financial institutions, but I dare say if we suddenly announced that we were going to one or two of these, it would freak clients out because ours is a very, very personalised service. And based on a very, very methodical investment approach. And that has worked. And hopefully it will continue to work. So we wanted to give assurance to people that got money with us that there will be continuity. And what I would say is that the next batch of youngsters coming through are hardworking, more intelligent than Jamie and I. We just throw our weight into everything we've done with loads of passion. Then it's paid off. But these next group coming through are fantastic. You've got great senior management team. So the company's in good nick from that point of view, and that's what Jamie was getting across. But we're not going anywhere because we love it too much. But there will be more people doing other things. and taking some of the day-to-day roles away from us, and that's a good thing because it's an evolution.
I think it's fair to say as well that having that clarity from an internal perspective adds value because everybody can see where they're going and everybody's heading in the same direction. Gary, thanks very much once again for your time. I will look forward to catching up with you again soon.
Cheers, Leah.